Hey, good afternoon, everyone. My name is John Gemini, Regional VP of Sales here at Angel Oak Mortgage Solutions. Hope everyone's having a great day today. We're going to let everyone log in, and then I'll introduce the two great subject matter experts who I've known combined probably almost 19, 20 years.
Yeah.
So, but we'll get started here in about another minute. And hope everyone's having a great month. We're almost halfway through it, and St. Patrick's Day is on Sunday. So hope everyone. I don't have any green on. Sorry, I didn't plan for that today. So, but hopefully everyone's having a great month. We're really starting to see a lot of positive momentum in the market from the non-QM side. So we'll share some tips and tricks with you guys, and hopefully get your year off to a great start. So give it about another 30 seconds and we'll get started here. I'm really excited today. Today we are going to talk about our debt service coverage ratio program, which is our second most popular program. All right, looks like everyone is logging in, so give it about another few seconds. Hello, everyone. My name is John Gemini, Regional VP of Sales here at Angel Oak Mortgage Solutions. Thank you for joining us today. This is going to be recorded. If we don't get to all your questions, we will have an account executive reach out to you shortly. But I'm honored to have two great subject matter experts and two people who I really admire and call friends. Annie Jensen, please introduce yourself.
Hey, John. Hi, everybody. My name's Annie Jensen, and I am currently in Seattle, even though I cover the Salt Lake City market, but it's a super sunny day in Seattle, which is wonderful. So hopefully spring is right around the corner, and I don't have too much sun coming into my eyes. But I've been a part of the Angel Oak family now, going on 9 years, and it's a tremendous company to work for, and I'm super excited to be able to present this program for you guys today. It's been a long time since I've done a webinar, and so I'm just excited to be on with everybody, and especially with Eric and John, two of my most favorite people over at AO.
Love having you back, Annie. Let's not let this much time goes before the next webinar. And then the guy everyone in the country knows, let alone California, and I call him, Eric, introduce yourself, and then I'll give you your nickname back to you. So
I thank you, John. Happy to be on this with you and Annie. You guys, Angel Oak, Eric. I'm in Orange County, California, and folks, we're here to not only make you money, but to have you thrive in the mortgage industry again. And there's much reasons to be very optimistic about your profession in the mortgage industry, and we're about to lay that out for you.
Yeah, thank you, Eric. And I always, I'm at trade shows in Florida, Texas, and everyone across the country, I'm not joking, knows Eric Morganson, and I tell him he should change his name to Mortgageson. So, but anyway, today we're going to talk about our debt service coverage ratio program today. It's definitely a very, very popular program, and it's investors that are still purchasing in this market. So, but before we get into covering the highlights, and we're going to go through a 1003, what we like to look at on a credit report, our quick quote tool, and really I think one of the most underutilized parts of our website is our marketing portal. So we're going to talk about all those today. So, but before we launch into the product, let's do a quick poll question here. Who has originated who has originated in the last 12 months a debt service coverage ratio program? So let's see what the results are. Still coming in. Wow. Okay. So we're at 72% of you on this call today have not originated a non-QM loan, which great. This is perfect. This is why Annie and Eric are with us today, to help you feel secure in closing these and give you some tips and tricks on how to find these borrowers. So that's probably one of the highest we've seen in a while. So thank you again for joining us, and we look forward to informing you on this. So everything we're going to do here today is from our website, really easy to use and navigate. So Eric, we're going to go talk about our debt service coverage loan. Eric, give us some of the highlights, please.
Well, first off, this is not a non-QM loan. this is a non-TRID loan. It doesn't fall into the non-qualified mortgage category because it's non-owner occupied. This is the space where hard money resides in non-owner occupied because they don't have to document the biggie, and that is the ability to repay. We all know that borrowers have a 3-year statute of limitation to sue their lender, and that being Angel Oak in this case, for their inability to repay their primary or secondary mortgage. Investment property, Congress doesn't give a hoot if the investor gets foreclosed upon. So I wanted to just clarify that designation. Now, there is a very healthy appetite for investors out there to buy residential rental property. They're not as rate sensitive as you're going to find owner occupied borrowers, because why? The interest rate is 100% tax deductible. It's not tax deductible to whatever their tax bracket is, like owner occupied. This is 100% tax play. So with that said, look at all the folks out there that really can't document enough income to go out there and buy rental property. So just like a hard money lender, we're really not basing it on income. We're basing it on collateral. That means the LTV has to be at 85% or under. Now, an 85% LTV rental property, we want to see that at 85% LTV. We want to see it 1-to-1 debt service cover, meaning if the payment to Angel Oak, including taxes and insurance, was $5,000, then it has to rent for at least $5,000. See, that's a 1-to-1 debt service cover, but that's a unicorn. You're never gonna, especially in California, you're never gonna have a property at 85% 1-to-1 debt service cover. Maybe, as Annie pointed out earlier, maybe a 4-unit property might, but at 85%, folks, we don't see those right now in this market. So with that said, we're okay if it's negative cash flows, meaning the rental income is $4,000, but yet the payment to Angel Oak, including taxes and insurance and homeowners association, if applicable, is $5,000. Now we're at negative cash flow. We can't go to 85 on that, but we can do that at 75% LTV and at least a 700 FICO score. So that, and we're seeing that all the time, because why? In parts of the country, especially California, real estate is so expensive that we have a hard time matching it with the debt service coverage or the rental. Annie, anything you want to add to that?
No, I mean, great things you all pointed out, Eric, especially, utilizing the no DSCR in this market. I mean, we have so many great ways to qualify, doing an interest-only payment, using short-term rentals, but in reality, it always comes down to that 70 to 75% LTV, utilizing the no DSCR, going down to that.
Yeah, guys, just to throw out some statistics here. 36% of the residential homes owned in the U.S. are owned by investors. And 70% of those are actually owned by individuals, which, that's why this debt service coverage ratio program is so popular, because the fastest way to accumulate wealth in this country is through real estate. And that's why you still have investors continuing to purchase. So Eric, just point out just a couple of highlights here underneath, some other highlights here underneath our debt service coverage ratio program tab here.
Yeah, like unlike Fannie or Freddie, we can invest in an LLC, which is smart for anybody that owns rental property, because if, let's say, somebody throws a rager in that rental property and somebody gets hurt, they can actually sue them for what they're worth. Putting in an LLC protects them. So we allow that. We allow unlimited amount of finance properties. Now think about that, folks. What if a borrower has like 4 different car payments, $120,000 on credit cards? There's no debt there is no DTI on these. So it's not like we have to keep it at 50 front end, 50 back end DTI. There is none on these.
Yeah, and then just the other benefit we see, Eric and Annie, is across the country is because, a lot of investors have more than 10 properties financed, and Fannie and Freddie won't give you financing on those properties. And Angel, we don't care how many properties you have financed, right? So Annie, let's talk a little bit about let me just make a quick announcement. Like, we have a question queue. You know, we're going to try to answer all your questions. Yes, this is being recorded. This isn't a PowerPoint slide. Everything we're doing today is on our website. So, but Annie, talk about, we kind of joke what the 1003 needs to look like. Take our audience through what we want to see on a 1003, or really mostly what we don't want to see. So.
Yeah. I mean, really, it's going to be one of the easiest 1003s you have ever put together. Because the two things we do not want to see is we don't care about their employment, you know, as Eric mentioned earlier, non-trade loan. So we're not verifying employment status, so leave the employment, leave that income off. We do not want to see that there is no DTI calculated. Now, what is important for us to see, obviously we need to see their housing history. We need to verify that they do own their primary. And then when the loan comes in for underwriting, we do pull a loan safe. So anything that's going to pull up under their personal name on title, list that under the REO section. That is very important for us to see, especially when your account executive is doing the pre-qual, so we can see the properties they already do own. If those properties are listed in an LLC on title, go ahead and leave those off of the REO section. It's also important for us to see their assets if they're doing the purchase. You know, where are those assets coming from for the purchase? You know, most of our programs require it. Most of them are around 6 months reserves. You know, if we are doing a foreign national loan, that's going to be 12 months reserves. So we also need to see where those reserves are also coming from on the 1003. But, you know, really outside of that, very simple 1003, no employment, no income, complete REO section, complete 2-year history of their primary residence, and we're ready to rock and roll and doing your pre-qual for you.
Yeah, and one of the things I want to make sure, because we always kind of spin this towards a seasoned investor. Eric, is this available for the first-time investor?
Folks, buying a rental property and renting it out is not complicated. So we're okay with a first-time investor. That's not an issue. Now, if somebody is renting an apartment for $1,500 a month and wants to do one of these really no-doc DSCR loans down the street and buy, you know, a $400,000 property and say it's a rental, well, that's going to be a stretch for us, because we're obviously, again, as a lender, we're fearful they'll move in and then potentially have an ATR violation saying, well, they told me I had a right that it was an investment property on on signing my 1003, and you know, I wanted to buy the property. So, but if somebody has, you know, 3 or 4 rental properties and is renting an apartment, we're going to be okay because they have a history of being a real estate investor at that point. Guys, it's common sense. If the loan makes sense to you guys, it'll make sense to us. If the loan makes no sense to you mortgage professionals, probably not going to make sense to us either.
Yeah, Eric, thank you. And hopefully, Cedric, that answers your question. And that was one of Cedric's questions. So thank you, Eric, for answering that. Annie, I have a question here. Is there a time frame? So this kind of goes down towards that road, maybe that Anisa. I'm not sure. I'm not even gonna try the name because I'm gonna butcher it. And so. Is there a time frame for when an investor has done a loan where they can do another one? So it's kind of like that rapid acquisition type of thing.
Yeah.
So,
you know, those are always case by case, because when we look at it, okay, what's already the book of business that they have? You know, are they already a seasoned investor, or are they a brand new investor? If they just made their first purchase and now 3 or 4 months later they want to jump in and make another purchase, then we might want to hold off on that. You know, we do look at the number of acquisitions they do make within a year. And I would say on a brand new investor, if we're seeing that they've just purchased 2 to 3 in a year, then we're probably going to hold off on that and see that they are able to effectively manage these properties. So it's really case by case. You know, are they a seasoned investor where, you know, if they already own 20 properties, if they make 2 to 3 purchases a year, then that's fine. They're a seasoned investor. They know what they're doing. Are they brand new? So really, that's something you've got to work one-on-one with your account executive. Like I said, that's why it's so important to have everything listed on the REO when we're doing that pre-qual for you, so we can see that and determine that up front.
Yeah, and our participant Z gave me the way out. Instead of pronunciating her name, she just said, "Call me Z." So Z, hopefully that answers the question. And I think what you can see, Annie being here 9 years, Eric being here 10 years, you know, you've got these seasoned account executives across the country, not just here. They are the best in the business, and you know, they're your upfront, and we have one AE calls them their convention. They should be your confessional booth, right? It's tell them everything up front, because Eric or Annie are not going to produce a pre-qual without knowing 100% that that loan can close. So I think that's really, really important. And we're going to get to show you how to submit, how to get a rate and how to submit a pre-qual. So a lot of questions coming in.
Real quick, John, I want to add one thing.
Go ahead.
As he was saying, you guys, we're in the common sense business. Listen, if the loan doesn't fund, our CEO doesn't get paid, our underwriters don't get paid, the people that work in the accounting department at Angel Oak don't get paid. Listen, we're vested with you to make sure that your loan funds. Now, if it's not a fundable loan, we're not going to waste your time. We're going to vet it out right up front in this pre-qual process. So you know if you got a deal or not. Nothing's worse than literally working on a loan, disclosing to the borrower, even paying for an appraisal, and then having the loan blow up on you. Doesn't happen on our watch here. The second thing is, we're in the common sense business. So if you've got compensating factors, you say a borrower has rapid acquisition of a lot of investment property, but has got $2 million in the bank. Well, folks, that makes sense that they can literally write a check and make all these mortgages go away. So we're looking at the entire loan picture on making a credit decision. And these loans are all risk-based pricing, meaning the lower the FICO score, the higher the interest rate. The lower the, the loan to value, the lower the interest rate. It is all risk-based pricing, and that's what John's about to get into.
Yeah, and Annie, we have Ed here asking about the LLC. You know, he's got an LLC here with 11, which I know the answer to, but I'll let you answer it. So go ahead.
Oh, okay. I'm sorry. I didn't hear what the question was, John.
Ed's asking about the LLC. What's the makeup of the LLC? How many people are allowed in the LLC?
Oh, okay. Got it. Yeah.
Sorry.
So no, we allow up to a 2-person LLC. You know, during underwriting, we're going to ask to see a copy of those papers. Very simple. It just has to be designed, you know, for managing, creating, you know, having rental properties. So super easy. They can close title in the LLC. Now they do have to have their personal names on the 1003, so it will report on their credit report. So that's the biggest thing with our LLC. They can close that title in the LLC. They are going to be personally responsible, and it will be on the credit report.
Yeah.
And so so if you do have a working with a borrower and they do have a 2-person LLC, then both of those borrowers do need to be on the loan. So let us know up front so that way we can review that paperwork up front and make sure we have everybody on the loan who needs to be.
And unlike a commercial loan, these are known as full recourse. So an LLC does not have a FICO score. So that's why the borrowers are going to be signing the note.
Yeah. Yeah. And guys, you know, we're going over guidelines here, right? We're giving you guidelines. 30% of the loans we close here at Angel Oak don't meet our guidelines. And, you know, whether it's assets, you know, reserves, you know, all of those things come into play. But as Eric mentioned earlier, it's a full picture. And with the experienced AEs that we have, they're going to get this up front for you. And we're not, Eric, Annie, myself, anyone across this country is not going to produce a pre-qual for you and put their name on it if they haven't gone through all the hoops for you at the start. We understand, and Eric's always talking about this, we understand what that referral relationship looks like. And no one at Angel Oak is willing to put that referral relationship on the line for you. So Eric, comes back to a little bit what you talked about earlier. I may be incorrect. Charlie is asking, I may be incorrect. I think our rep told us that we can do up to 5 loans or $3 million. You talked about it earlier, Eric. Let's put a little bit more around that narrative, if you don't mind, please.
Yeah, our exposure to any one single entity, that could be a borrower or even an LLC, we're going to limit. And again, it's going to be case by case. We normally would limit it from 3, sometimes as high as 4 million to a single individual. But on that 1003, you guys, and don't shortcut a 1003. If you really want to find out all their asset, because those are literally compensating factors. So as we look at the 1003 and how sophisticated the borrower is, we can push the envelope on a lot of occasions. As John mentioned, we're in the exception business. Again, nobody here gets paid unless your loan funds, and we're going to try to make your loan fund in any which way we possibly can.
I'll take that reference to me as Bob as a compliment. So thank you. So, so Andy,
Wherever you are, wake up.
hey, Andy, talk about which was a recent enhancement about gift funds.
So now we allow gift funds on investment properties. So long time coming, really excited to offer this, but super easy. Borrower just needs to bring in 10% of that down payment, and then we can use gift funds for the remaining. Just need to be from an immediate family member, and we can use them. So they can reserve still need to be in the borrower's name, but they can use gift funds for the remaining down payment and cash to close.
Hey,
making
Eric,
it easier.
Sorry, Eddie. Hey, Eric, talk about another recent enhancement, seller concessions.
Yes, we used to, it was 3%, now it's 6% seller concession to buy an investment property, and that can buy down the rate, that can pay a lot of even maybe your origination for you guys. So you've got a lot of options here.
There's a lot of great questions coming in here. Eric, I'll go back to you because you talk about making people money here. Chuck is asking about lender paid comp or borrower paid comp.
Okay, in this environment, going into an election year, folks, you want to tread lightly on going lender paid comp. Now, buying out the prepay, so all investment properties, even with our frenemies, our friendly competitors, come with a 3-year standard prepay. Now, if you put the borrower into a 4 or a 5-year prepay, it lowers their rate. However, buying out the prepay gets very expensive. And with that said, it's going to come with a cost. So you'll see a par rate and then what the cost is. We do offer both lender paid and borrower paid comp.
Yeah, and Eric, that's a great tip because, in this highly competitive environment, borrower paid is I'm seeing it. I'm probably seeing it almost on 70, 75 to 80% of the deals we're closing today. So, Annie, Katie is asking about the LLC, a little bit more info on the LLC. Does it have to be only for setting up for real estate, which is a great question, thank you, Katie.
Yeah, no, great question, but we do. It does need to be real estate based. It does need to be for the purchase of investment properties, the management of investment properties. We have an LLC come in and it doesn't have it stated what it's for, or if it's a completely different business, then we are not going to be able to close that under that LLC. So it does need to be for that property. It doesn't need to be for that property specifically, but it does need to be for rentals.
And I'll take her question one step further. How long does the seasoning have to be for the LLC?
Oh, they can happen open like a day before we submit the loan. There's no seasoning on that LLC.
Yeah,
that's yep.
Hey, and sorry, Katie. Eric, Emilio's asking, do we do prequals on TBDs?
Yes, we do. Absolutely. We do not need a property, but it's nice to have the property because we're going to vet that out and let you know that we can do a loan on that. What's nice about these DSCR loans with Angel Oak is we will allow them on rural investment properties. Are you kidding me? Rural investment properties. Up a $3 million loan size is here, you guys. We use 100% of the fair market rents on the 1007 on the appraisal. We're not using 75%. We use 100%.
Yeah, that's huge. And Annie, talk a little bit about the ratios. And I'm going to scroll down here a little bit. We have a calculator on here.
Yep.
Talk about the different debt service coverage ratios that we have.
Okay. So the standard debt service coverage ratio is going to be our 1-to-1, and that is where the full mortgage payment, and that's everything included, taxes, insurance, HOA fees, it has to equal our mortgage payment. Now, as we have discussed earlier, especially in this market when real estate is higher right now, some of those loans, it's going to be very difficult to meet that 1-to-1. So if we're doing to 75% LTV, then we can actually go down to a 0.80, which means we're going to allow that mortgage payment to be 20% more than what that market rent is. Now, at 70% LTV, then what we're going to do, we're going to say, okay, with a 700 or better, or some instances 720 credit score, lower LTV, we're going to say, okay, we're going to allow for that high risk. So we're actually going to have no DSCR. So that mortgage payment could be, we could have a $4,000 mortgage payment, $2,500 market rent, and we are going to be okay with that at that 70% LTV. Now that's doing a purchase. If we're doing a cash out, then we're going to have that LTV be a little bit lower at 65% LTV. Now keep in mind, these are using our long-term market. If we're doing like a short-term rental, then those are always going to be at a 1 DSCR. Same thing if we're doing a foreign national or a non-perm, those are always going to be at a 1 DSCR. So, but that's something very important up front when you're working with your account executive, you know, especially if we do a TBD and then they go under contract, we need to see that address, especially on a purchase, so that we can do an evaluation. One of the favorite things I always love to do is, yeah, Zillow has the estimated market rent on there, but I always take it a step further when I'm working with my customers, is I'll actually go into Zillow and I'll see what's listed currently for rent at this specific time, and I'll pull up the like properties just like our subject. And that is really the best way that I have been able to estimate what that market rent is going to come in on the appraisal. And so really, if we're using long-term market rents, you know, work with your borrowers up front, make sure they have enough money to do that 30% down payment, because that's what I'm seeing right now. It's all going to be between 25 and 30% down payment. And so even though when I get those scenarios and they want to do the 80%, I'm being honest with them and I'm saying, hey, make sure going into this, they have enough for that 30% down payment to utilize that no DSCR, because that's what I'm seeing a lot in this marketplace.
Yeah, Annie, great explanation, and again, shows why you're the best of the best here, right? You do all that work up front and have those conversations with that originator to make sure that, you know, they're working the best way with their borrowers, and again, you know, cherish those referral relationships. Eric Hans has a great question here. If a borrower has 5 rental properties, do we need to show reserves on all 5 or just the subject?
Just 6 months on the subject property. And if they're doing gift funds, we want to see that the borrower has 10% of their own money and 6 months reserves of their own money. So, yep, we do that. And what about the folks out there, John, that might not be licensed in Colorado, hot state, Florida, hot state, Washington, hot state. Mm-hmm. If you're not licensed in those states, we allow you to do these loans in those states, even though you might not be NMLS licensed in those.
That's huge, Eric. And I just scrolled back up. These are the I don't know how many that is, 12 maybe, 12 states that we allow that to happen in. So again, talk to your account executive, and they will. You know, that's what I love about you guys and all of our account executives. They hold your hand through the entire process. There's no, hey, submit a loan, and underwriters don't need practice underwriting files that aren't going to close, right? So, and we've got the best underwriters in the business. So, but our account executives are going to hold your hand throughout that entire process. So, Eric, talk about condos, and I'll touch on a little bit on condotels.
Non-warrantable condos are everywhere out there, you guys. Fannie and Freddie push back if 35% or more are rental properties in that condominium complex. We think that's silly. We allow the entire condominium complex to be rental properties, especially in college towns, you guys. So we love non-warrantable condos. If somebody slips and falls and gets hurt and they're suing the homeowners association because of a slippery staircase, we're okay with that. Where we push back is if there's construction defect lawsuits. But everything else, let's have a look at it. And as John was saying earlier, folks, we're not in the mortgage business here. We're in the service business. The service part of doing this is the fun part. Honestly, we're vested with you to make your loan fund, and literally give us a call. We love wonky scenarios, condotels. Certain people are in certain areas on this call, and if you're in Florida, boy, look at all the condotel opportunities out there. So with that said, we love scenarios. Listen, any check that ever hit your personal checking account from doing a loan, that check first started with a loan scenario. Give us a call. Maybe you haven't spent, the 70, sometimes I've heard brokers out there paying $90 for a credit check. You haven't run credit yet. You haven't fully baked the 1003, but you're wondering, geez, well, is this a doable loan? Give your Angel Oak account executive a call, and we'll talk through the loan and literally massage it into a funded loan, hopefully.
Yeah, so I just want to, yeah, Eric, just great points just across the board there. And that's why we have the best AEs in the business. Yes, and I just want to do kind of just a public start. This is being recorded. We will get a recording out to you before probably midday tomorrow, just so everyone knows that. And everything we're doing today is off of our website. So just a couple other things. There's a question here. Hans is asking another great question. Sorry, move down. If someone purchasing a short-term rental, how do we calculate income on that property? Annie, this may be a good time to talk about AirDNA, which is, again, another great enhancement.
Yeah, short-term rentals. So, yeah, great investment opportunity, and now we do allow the use of short-term rental comps. But one thing you have to be mindful of, if it's not in an area where you have a lot of short-term rentals, then the appraisers are probably going to have a very hard time getting those types of comps. And that's been the biggest struggle with using the short-term rental comps, is the appraisers having access to that type of information. So now we do allow the use of AirDNA, and that's something we can pull up during the pre-qual, and we can see, okay, will this qualify doing the AirDNA? And what's great is we will actually use 100% of what is coming across on that AirDNA. So if it says, projected income is 150,000, we're going to do that 150,000 divided by 12, and that's going to be our market rent on that. So we can definitely use AirDNA, short-term rental comps, during the pre-qual. If those aren't going to work, we can always fall back and do the long-term rental comps on that purchase. So just more options to help you guys.
Yeah, and as Annie mentioned earlier, we will do, yes, you've heard, we will do a no DSCR. And, so you have, I almost call it the waterfall of scenarios, the greater than 1, 1 to 1, less than 1, and no DSCR. So, but one of the other things is, how do you, Summer's asking, how do you estimate the rent when applying, because you don't have the appraisal yet? And Annie did a great example earlier of, go ahead, Annie, repeat what you do in your pre-qual about Zillow.
No, my favorite thing is to go into Zillow and see what's listed currently for rent, in their neighborhood, and pull up the properties. They're just like our subject property, and I do my estimates based off of that. And so far, all my pre-quals and everything, when they come into loans, they've all gone through very, no problem. So that for me has been the best way of determining the market rent on the purchases.
Yeah, and Eric, I'm going to make you the bad guy on this one. William's asking about mixed-use properties.
Mixed-use properties, we are not a commercial lender. We are 100% resi lender. So let's say how about Florida? You might have a high rise. The bottom floor is retail. Maybe a couple floors above is office, and then it goes into a high rise condo. Yeah, we will lend on that all day long. But if a part of the front of a house is commercial zoned, and you got retail in front, and the back of the house is a residential property, we're probably going to be pushing back on that.
Yeah, and Hugo, I'm going to share with everyone my contact information through this question queue. So if Hugo, you want more information about condotells, I'll have your account executive reach out to you. And Tony, I agree. Oscar is a great AE. So thank you for that. Shout out to Oscar, Tony. And then Eric,
hey, John, let me mention something really quick. Folks, there's interesting trends in the mortgage industry right now. The phenomenon of VRBO, basically short-term rentals out there, we've never seen this before in the history of what we're doing here. They're cutting into the Marriott and the Hyatt and so forth. Now, with these short-term rentals, you got to understand that's the millennials out there that want experiences. They're not buying jewelry. They're actually traveling and wanting experiences. They're renting out these VRBOs. But the average age of the American real estate appraiser is nearing like 60. They're not jumping into these VRBOs. So it's a little bit wonky for them to understand short-term rentals. They want to just go off of an annual lease, which is a lot lower than what you can make off of short-term rentals. It's day and night. An annual lease might be $4,000, but short-term rentals, you can make 12 grand on that same property. So that's why AirDNA will literally drill into the modern VRBO pricing on short-term rentals. Guys, take advantage of what is going on with this American phenomenon of short-term rentals out there. And we cater to that.
Yeah, Eric, yeah, great information there. Hey, Annie, Nancy's asking, and this goes back to, again, how great you do on your pre-quals. How can one do a DSCR on a vacant property? So maybe, Annie, go into what we look for in purchase, and then maybe talk a little bit about what we won't allow on a cash out. So.
Yeah. So on a purchase, same thing, we'll do the pre-qual on the TBD, but then the moment you have that address and they go under, we have that address under contract, reach out to your account executive so we can review the property, make sure it meets our guidelines, do our work up front. That's to determine the DSCR, to determine our LTV. If we're doing the cash out, then when it comes to a no DSCR, then if that property is vacant, so let's say we're working with an investor, they purchased a property, they have a hard money loan, they went in, they rehabbed it, now they're ready to rent it out, but they want to get that hard money loan paid off as soon as possible and they don't have a renter in there yet. We're okay with that property being vacant, but what we're going to have to do is we're going to have to do the no DSCR option. It's a 70% LTV and have that pricing based off of that no DSCR calculation. That's if we're doing a refinance. So even if you're doing a cash out, same thing. So we're okay with that property being vacant. It's just going to have to go down the road of no DSCR.
And Eric and Annie have mentioned this a couple times already. That's what your account executives for up front at that pre-qual stage. Those are the questions, the second, third level questions they're going to ask to all of you that are working with us. So a couple other questions coming in here, and then Annie, I'm going to have you cover a little bit of yes, Nancy. So we can use that market rent analysis for that vacant properties. Yes. Hey, Eric, talk a little bit about, and what I'm seeing a lot more cash outs, and more on how these come in multi-packs, right? Go ahead.
You guys, we're in a cash out market right now. Rate and term, we can all just have a moment of silence because rate and term is no longer. But at Angel Oak, we have opportunities. We allow new appraised value after only 6 months. And as far as cash out for self-employed individuals, boy, do they ever want access to capital. And never before in the history of our profession has there been so much equity in residential real estate. Never before. Never before in the history of what we're all doing here in the mortgage industry has consumer debt been at its all-time high. SBA loans, car loans, credit card debt. Never before in the history. Never before in the history of mortgage banking has a first mortgage interest rate in place been so low. That includes, literally, that includes even rental properties. With Angel Oak, we allow bank statement seconds. You guys don't even get me started on that, to pull equity out of residential real estate, whether it be owner occupied or these investment properties. Now, that would be a bank statement or full doc. We don't do a no doc cash out second on investment properties. However, folks, you want to get rich on the niche, focus on equity loans, you guys. That is the future in mortgage for the next 5 to 7 years, access to capital.
Yeah, Eric, so I'm gonna tighten up some of these stats here. So, give me just about 30 seconds. So as Eric mentioned, there's more equity in homes now than ever before, right? There's I think every home across the average home has appreciated since 2019 by 47%. That's average. There are pockets like Florida, Texas, California probably gone up even more than that. Eric, you talk about debt. There's so much, there's over $1 trillion of credit card debt. There's in 2022, there was $120 billion, $120 billion in credit card fees and interest rates paid. That's, yeah. So, everyone's talking about how inventory is not out there. You can go create your own cash out refi boom. I mean, people have a ton of equity. Yes, rates, they might be higher than what they are, but the average credit card debt is over 24%. Over 24%. So I'll get rid of those stats. So let's look at it. Annie, let's cover, we've got about 20 minutes left. Annie, let's cover
Perfect.
foreign national. Go ahead. If you would.
Yeah. So foreign national loan, this is a wonderful loan. This loan is designed for your borrower. They live and they work and they have citizenship outside of the country. So I tend to see a lot of borrowers from Canada. You see a lot of borrowers from Europe. I've actually done borrowers from Mexico, down throughout South America, where, as we've been talking about, equity, real estate, that's how you build wealth. And so they all want to own that real estate here in the United States, and this program is going to allow them to. And so, for example, what we do is we'll go up to 70% LTV, and this is going to be a very easy loan to do for your foreign national borrower. So again, it's all based off the DSCR. And this one, we do have to be more mindful on the DSCR because our minimum is at 1. We cannot go below 1 on that DSCR. So we do need to be mindful, like they might have to come in with more than 30%. They might have to come in with 40%, depending on what that market rent is on that final appraisal. So it's very important we do our diligence upfront to try to estimate, and so that way we can really nail down that LTV. But wonderful program. The down payment for these funds do need to be in the U.S. for 30 days. So if they do not have a U.S. bank account, they can wire it to title and escrow and they can hold it. Reserves are 12 months on this program, but reserves can stay in their bank account in their home country. So yeah, it's a great way to allow that citizen or of another country to own property and build wealth here in the United States. So they also need to have, list of eligible visas. On this one, no gift funds allowed. But if you come from a visa waiver country, it's not a problem. Even if they do not, when it comes to signing on these loans, is we do allow them to close at a U.S. embassy. So that way they do not have to be here in the United States. I actually do this a lot. I actually just had a loan closed in Scotland over at a U.S. embassy in Scotland. So we do allow that to make it easy for these borrowers for closing.
Yeah, Annie, this is, with all the political strife going on all over the world, you're seeing a lot more. We're seeing an uptick in foreign national buyers, and one of the marketing tips I always say, a lot of foreign nationals want to send their children here to study in the U.S. If you're around a large university, what better way to market yourself to that as a purchase? I've got Stacy in Florida always says, that the 30 days of seasoning that we require that to be in the U.S. and you mentioned it, Annie. Have them wire over extra because that clock will start tick again if they didn't wire all that money over. So that's just another tip and trick that these great account executives we have across the country, not only on this webinar, but those are tips and tricks that get you your loan closed sooner rather than later. Eric, anything else to add to foreign national? Sorry.
Yes. A landmine there is visa types. We don't allow student visas in this program. Probably the reason because of the phenomenon that is known as beer. So you're living in a foreign country, you've really made it. If you can send kids to school in America, their freshman year, they maybe pledge for a fraternity, get introduced to beer and fail out. And the parents are like, what, you're not getting your grades? They pull them out and then walk from the property. So student visas not allowed. Just needs to one-to-one. You guys think about this. No credit report, no income. It's the easiest 1003 you could ever fill out. Just the property has to one-to-one debt service cover. It's just as simple as it gets.
Yeah, Eric, you reiterated a question that James is asking. How do you verify income for foreign national? We don't have to. Again,
zero.
So this piggybacks on the debt service coverage ratio program, right? So we're just as Andy mentioned, we're just qualifying the borrower on how that property cash flows, and that's it. Like no credit, no job, no income, just have a visa, or if you're from one of those visa waiver countries, a valid passport, even better. And that's what most of the Canadians that we close loans for have, just a valid passport. So,
favorable nation status, yes.
Yes. Yeah. So, Eric, I know we've got about 15 minutes left. We've had a lot of questions about pricing. So let's take me to Eric. Let's go back. I'm going to go back to our homepage so we can show people there's a couple ways to get rates, right?
That's right. No login, no password needed. Everybody on this call, do you need another password and username? No. You don't need any of that. So you can even have this on your phone. So as you go right in, look at John needed no login, no password. Well, first thing it's going to ask you, lien position. Second thing it's going to ask you, what's the loan size? The reason why we need to know the loan size is the bigger the loan size, the lower the rate here. Don't you love that? So with that said, then we want to know the credit score, the loan to value. Let's see, what kind of scenario are you doing here? A DSCR, no doubt. Okay. Listen, there's no lift, whatever state you're doing it in, but we want to know the state because you might not be licensed in, let's say, Florida. Putting Florida there, now we want to know if you're licensed there or not. It's okay if you're not. We just want to know that on the pre-qual here. So he's putting DSCR, investor cash flow.
There we go.
And now, really quick, I want to focus on this. You see the DSCR, folks, the better, the more positive rent roll cash flow of the property, the less risk of the loan, the better the interest rate's going to be. So the better it cash flows, the better rate. If it doesn't cash flow, like a negative cash flow, well, it's going to get hit to the rate a little bit on that. So as John goes to 1:1 to 1.10, we got a 7.625. Now let's go negative cash flow, John. Let's say, yep. Now look at the rate, 8 3/8. You see, it's all risk-based pricing here, common sense. Now let's go to the view rates, John.
Okay. Eric, one of the things that, you see that rate of 8, whatever, but that's no income, no job, no lease agreement, no tax returns. So like Eric said, it's all risk-based pricing. So
no history of even owning an investment property. Never done it before. There's no hit for that.
Right.
So right here, it lands directly on par at 8 3/8. Now, a lot of brokers will put the borrower into, I don't know, into an interest rate of 8.75. And now we're giving that borrower a lender credit of $4,375. That might literally go towards the loan officer's origination fee. See, what you can do is you can literally add a little bit to rate, and we give your borrower a lender credit to counter your origination fee. See,
Eric,
it just keeps getting better.
Yeah, so Eric, a question came in that I think is really important that, mortgage rates. James is asking, James, we will allow a 1 × 30 in the last 12 months. So that's pretty big,
You guys, it happens every now and then. Somebody's on vacation, forgets to make a mortgage payment, whatever, and now they want to buy an investment property. Go time here at Angel Oak.
All right, so Eric, so right here, if you selected a rate, have you locked your loan?
You can float or lock. So right now he's gonna go ahead and select a rate.
I did.
He did? Okay, he's gonna scroll up. A lot of times, depending on your screen, see how he scrolls up? Right there, if you know how to extract a 3.4 MISMO, just literally drag it right into that box and hit next. Or if you don't know how to, that's okay, just hit the next button. So now we're at step 3 of a pre-qualification, and this applies for bank statement loans. Any loan that we've ever funded here at Angel Oak all starts by becoming pre-qualified. So now we just want to know your contact information. You'd fill that out there. Scroll down a little bit, John. Just simply print your PDF or print your 1003 or IRLA to a PDF and just drag it right there. We're asking for the 1003. Drop in your credit report. By the way, you guys will take a soft pull if you don't want to spend the big bucks on doing a full tri-merge at this point. We will take a soft pull for you, save some money on that. As you can see, don't need a 1008. It doesn't have that little red asterisk because literally there's no debt to income ratio, so we don't need a 1008 there. And down here, a lot of times you might have already, the loan blew up somewhere else and you have an appraisal. Drop that appraisal in there. We do take transferred appraisals, so that's nice. Then we want to know if they've had a bankruptcy or a housing event means a foreclosure. Credit event is a bankruptcy. By the way, it's not hard money anymore. It's private money. See, great new terms, right? and then just hit submit. That will go right to Annie will get that pre-qual request. She'll look at the 1003, massage it, get in touch with you and go, hey, game time, here's the approval. Now it's time for you guys to order the disclosures. What we're going to ask you to do is literally fill out a disclosure sheet. What we're going to do is we're going to draft the LE and send it back to you to make sure that it's correct and you're getting paid what you want to get paid. Once you've approved the LE, then we disclose to the borrower. We're using Encompass 360. So your borrower's going to get an email from Ellie Mae saying, hey, you're doing a loan with First Mortgage Company. Thank you very much. We're the investor behind it. Do you mind if we electronically disclose to you? Yes or no? Click the box. They say yes. They come up with their own login and password, and now we've electronically disclosed. Really simple process. We've been at this for over 10 years, and we have this system down pat.
Yeah, Eric, I mean, you basically just told the entire webinar on how you and Annie and all the other account executives across the country hold their hand through the process. And one thing I will correct you on, why would you send the loan anywhere else if it fell out? Come here first, right? This is where you need to be. So Eric, thank you for taking us through there. So Annie, let's talk about our marketing portal.
Perfect. So let's go ahead, let's get signed into our marketing portal. So we have so many great things that are going to help you in this marketing portal. So we're going to jump through just a few of my favorites once we get signed in here. Now, if you don't have access to our portal, super easy to get access. Just go to our homepage. You can get your broker user form from our homepage. If not, you can email your account executive. They'll send it to you. Just fill it out, and we'll get you your passwords within a couple of hours of returning that form to us. Now, once you log into the portal, what you want to do is go over to the marketing. And the first thing let's do is let's go down to the flyer section. So, as we always say, how do we find these borrowers? And the first thing to do is just get out and start talking to people. We have these flyers. They're 100% ready to go. Go visit real estate agents. Go visit people who are working with these borrowers already. Even hard money lenders. I have some LOs who have very valid relationships with hard money lenders, and they do a lot of their takeout loans. And so once you find the flyer, we have several for DSCR, then all you have to do is just click on that flyer, fill out everything on the left-hand side, and then go ahead and click update. And then that's going to update everything with your information. You could put your logo on there, you could put your picture on there, and it's ready to go. So if you want to do old school way, go out, hit the streets, stop in offices, say hi to people. You can do emails, you can attach them to emails. But this is a great way to be able to get out there and what you have access to. Now, what's wonderful about marketing is a lot of my, seasoned brokers who have been in this business for a long time, everything's evolving over to social media. So let's go back over to the tab to where we have the social media flyers. And there we have flyers that are ready to go. You can post on social media. Now, I do have brokers, and they do their own social media flyers. But what I love about social media is really what sells. And I've seen a lot of my brokers, over the 9 years I've been at Angel Oak, evolve their marketing. Some of them in the very early days did a lot of email marketing. And they had great networks between real estate agents, CPAs, asset management firms, to be able to email to get referrals. Now it's really evolved into the social media. And what I've seen the successful brokers do on social media is they're posting at least 2 to 3 times a week. They're posting, this is what I can do. Banks turn down these borrowers for this reason. This is what I can do, whether it be bank statement, whether it be investment properties. This is how easy, no income. I qualify off the bank statements. I qualify off the cash flow. It's like a commercial loan, but for your personal. And so, but the most powerful tool I've seen them do is, from one of my top brokers, is the moment he closes a non-QM loan, he's telling the story of the non-QM loan that he just closed. So he is selling the story for his audience out there. This is the reason why it fell out, and this is how we got it closed, and this is how we did it. So not only is he giving the reason, like, hey, these borrowers exist, but he's selling the they close, and we close them very easily out to his entire network. So he gets a lot of referrals, and he has built up a very good online presence just from doing the social media marketing. So he'll do this both on LinkedIn and on Instagram, and it's become a very, very powerful tool. So definitely, if that's something you're not doing, I strongly suggest get on and start selling the stories and start selling the highlights of what you can do, especially in this marketplace. Now, since we are running low on time, I do want to go into one more thing. Let's jump back over to the marketing portal, and that's our presentation. So right now, yep. So let's start getting ready. So as we all know, we have these realtor presentations. They're 100% ready for you guys to go do. So hit the ground running. You know, we're all anticipating it's going to be a great year this year. So let's get in front of our realtors. Let's let them know what we have. To make it even stronger, Angel Oak, we have account executives across the entire country for you. We have subject matter experts where you live. So invite them into these meetings. We are the experts, and we have the stories that sell. We all know stories sell. We can come in and we can tell the stories of the closed loans, and we can help build that trust within those real estate agents when they come across that borrower. Because a lot of the times, you know, these real estate agents, when they start working with the borrower, do you have your pre-approval? If that borrower is like, oh, I don't know if I qualify, you know, maybe my tax returns, maybe my credit, I'm self-employed, I don't know. The last thing we want that real estate agent to do is go, oh, okay, you probably don't qualify. If you don't qualify for our conventional loan, we're going to stop right here. No, we want that real estate agent to go, you know what? I just had this wonderful presentation, and we have other options for you. Call so-and-so, and they are going to get you pre-qualified. So really, tap into that real estate market, utilize your local AE, bring them in on these presentations, and let them sell non-QM for you.
Yeah, Annie, I think it's the most powerful presentation. And I've heard account executives across the country say they've had more requests to do realtor presentations in the last 6 months than they have in their previous 7 or 8 years, you know. So, and again, this is customizable, and I'll use, you know, Hans has been asking a lot of great questions here. So I always tell, we come in there, we're just one of your investors. We don't say anything about Angel Oak. You know, we're just one of Hans' investors, and we're going to talk about what we can do and how we can help you close more loans and move more houses and stuff like that. I know, Eric, you do a lot of these. Talk a little bit on how powerful they are.
You guys, just getting the word out that you have access to these programs. Listen, every loan officer in America and every realtor knows that every loan officer can do an FHA loan, a VA loan, a Fannie or a Freddie. Yeah, everybody can. That's not a big deal. What is a big deal is you have access to loan programs that these realtors still do not know exist. And anytime you do a realtor presentation, invariably, if you do one in front of 15 or more realtors, by the time you're done doing the presentation, 1 or 2 of those realtors are going to come up to you and want one of these loans for themselves. Think about it. A realtor literally gets paid into their personal checking account from their broker of record, but they write everything off. So they don't qualify for a loan, but they stumble upon these great purchase opportunities. So with that said, just get the word out, folks. And
yeah, Eric, 9% of the loans we close on bank statements are actually realtors. So it's we track that information, so it's available. So yeah, you get 12 people in a room, you're going to get one of their loans. It's it. Hey, Eric, just talk about, you know, we didn't talk about it, but talk about how fast we can underwrite it and close a loan, please.
Folks, any loan really taken over, 15 to 17 days, depending on weekends or holidays, is because we're waiting on you and your borrower for conditions. Listen, appraisal turn times are great now in this market. And with that said, folks, if you have a very proactive processor, these loans are going to swim through. But here's where you're going to go off the rails, even with our frenemies, our friendly competitors. If that 1003 that we get, if the story changes as the loan goes through, there's where it's going to delay loans. So have that 1003 completed at the get-go, and you won't experience any delays. Again, if the loan story changes as it goes through underwriting, there's where you're going to find delays.
Yeah, and Karen, yes, we will underwrite a file on a debt service coverage ratio without an appraisal, but we won't get you we won't clear to close that file without that appraisal. And as Annie said, that's the one variable basically in which is, other than that, a bulletproof loan is the unknown of the appraisal. But like Annie mentioned earlier, she'll go into Zillow and give you, what she sees for, if we have that property, what she sees for what that might give you as I think they call it in Zillow as estimate, right, for rent.
Mhm.
So, but anything, Eric, I know we're at the top of the hour. Anything else in closing, Eric?
You guys, if you haven't tried Angel Oak in a while, or you never tried, just try us with a scenario and you tell us what you think. With Angel Oak, you guys, if it's a bank safe loan, which we do the most of, is we're giving you a full income and credit underwrite right up front, often same day, depending on when we get it, even on a TBD property. Now, it's not a full underwrite. We don't have the appraisal, we don't have title, but credit and income, a full underwrite right up front. Boy, that can make you look really good in front of a realtor who now can go to their client and say, here's your purchasing power, go get them.
Yeah. Annie, give us something in closing as you always do.
Well, it has just been absolutely wonderful to be here with Eric and you, John, today. You guys are my favorite over at Angel Oak, and it's been such a joy to present DSCR. And really what I love is, living up in Seattle, I'm in the tech industry. And so, a lot of my friends, work in tech. And one thing that's so unique about our industry is we get to see the end result. So we get to hear the stories when they're at the closing table and they were declined. And so that's something really special in our industry is we get to be a part of the American dream coming true. And we get to help people achieve that success. And we get to help people really build that wealth. And so that's what's wonderful, and that's my why. And that's a lot of the why of everybody that works at Angel Oak every single day is we want to be a part of that and help everybody achieve that. So come help us. Come be a part of that with us and achieve it with us. And, together we're all going to close loans and put people in a much better, position to build wealth and achieve that American dream.
Eric, what do you love?
We love scenarios. Yes.
I was wondering if you were going to pick up on that, but yeah, so, we're at the top of the hour. Next week, Eric touched on bank statements. Next Thursday, we're doing a deep dive into bank statements. So, and we've had enhancements there. So hopefully we can help you close more loans. And as Eric mentioned, for those of you who have closed loans with Angel Oak, thank you so much for your business. For those who haven't, with the subject matter experts that we have, give us a shot because they are the best in the business. So hopefully everyone has a great rest of the month. And use this stuff to grow your business, and hopefully everyone's going to have a great 2024. So, Annie, Eric, thank you so much. I really appreciate you guys taking the time out of your day, and have a great rest of your day.
Thank you, John.
Thank you, everyone. Thank you.
Thank you, Moses.